Toxic. Tell me about that. Why?
There's a lot of political pressure right now for President Biden to get rid of Jay Powell and to put someone who's more woke-ish, who's more aggressive against the banks, and perhaps a little bit more lenient in terms of the timing of the Fed early tapering discussion. I think one of the things that should be very aware of is that so far we've only heard from the more hawkish members of the FOMC, and I can guarantee you at the next meeting, neither Bullard, George, nor Kaplan are going to be dissenting votes. Why? Because they're not voters. And so one of the traditions at the FOMC is you get the people who are not voters to take the more extreme positions. I'd like to hear, for example, from Mary Daly, Charlie Evans. These are going to be voters for the rest of the year, and they're the ones who will be setting the timing of the tapering discussion. And Kaplan won't be a voter until 2023. So these are things that I think the market is well aware of, which is why the reaction today in the marketplace isn't so extreme to this kind of early tapering discussion.
So is it in the category of idle talk then, or are these folks just not even heard?
Not at all, Tyler. In fact, I think, as I said, it's the tradition in the FOMC when you want to announce policy changes is to get the early extremes out in the open and have that discussion so that the markets are ready. And I think the lesson learned from Chair Bernanke is don't ever say anything that says autopilot. Don't say anything about models. Chair Powell, when he came to office, said, we make decisions. Human beings make decisions, and we're not driven by models. We're not mechanistic. And the discussion is showing the extremes within the committee. And Chair Powell is going to do the wise, sagely thing of pulling together his consensus and saying we will have a moderated pace of QE tapering, and it will depend on the data. So it will surely stay away from any sense of automaticity or model-driven decision-making.
And they're not going to have the August jobs report until after Jackson Hole, Bill, and that would seem like a key data point like we've been discussing. But I'm also glad you brought up the autopilot. I think people forget already about 2018, where if you said, when did the Fed start cutting rates, most of us would say 2020 after the pandemic. But no, they started cutting interest rates in 2019. When the economy was in the very late stages of an expansion, when unemployment was dropping in a good way for a lot of the groups that had been kind of stuck at high levels since the financial crisis. Why were we cutting rates in 2019? And what does that tell us about the Fed's likely moves into next year?
I think one of the things that we have to keep in mind is that the data and the situation of the economy is highly, very important, and the Fed is highly dependent upon knowing what the economy is doing. They're not going to be forecasting what it's doing. They're going to try to say, what is the economy doing? So I think one of the things that we're going to have to watch out for would be tail risk, the things that would influence the data that are coming out from left field. One of the things that's not talked about well enough, I think, is the amount of fiscal expansion we're having, and also the extent to which COVID is not only affecting supply chains here in the U.S., but abroad. And that will prolong the duration of the high inflation we're having now, because so many of the bottlenecks will not be alleviated if COVID takes off in our Asian supply chains and in the European supply chains. So these are the tail risks that I would personally worry about, and that I've encouraged our sponsors at Milken to worry about, which is to say, look at what will influence the data to be reported over the next several months. And there, I think the tail risks really come into play.